Hey everybody, it's the middle of the day, Thursday, April 25th, and on today's episode, we're going to be talking about the 15% drop in Meta or Facebook shares overnight, where they reported better than expected quarterly earnings yesterday, but forecasted increased investments over the next few years in AI through CapEx, sending shares of Facebook stock down 15% in the over hours, a gap down. And so the question for today's video is, should we be afraid of investing in a high quality company which is investing in itself? We're going to answer all those questions and more right after this.
You need to diversify your bonds.
The only problem you're going to have is that you didn't buy more. Because by the time you read about it in the Wall Street Journal, it's already too late.
Let's jump into things. We're going to do a quick update on the portfolio today, sitting at $76,000, about $100. The market is down 0.72%. My portfolio is down a bit more, down 0.8%. And today we've got some outperformance from different parts of the world market. So we have outperformance here with Coca-Cola FEMSA, Wheaton Precious Metal, Tesla, Domino's Pizza, and Netflix. So a pretty mixed bag, as it were. And then some of the stocks that are suffering today is Meta, which has recovered from its opening by a few points, but it's down over 11%. Then we have Caterpillar, which is lower on bad earnings. Winnebago is significantly lower. Not sure the news there. And then we have two marijuana stocks that are substantially lower. So let's just dive into the topic of today's video. I'll ask you to like it and subscribe to the channel, and we're going to get started. So I do own Meta stock. I own probably about $500 of it, and then probably another $1,000 of it through index funds and what have you. And, the story of this stock is pretty interesting. So if you look at its drawdown from the height of the COVID crash and meme crisis boom of 2021, we can see that it had a max drawdown of 76%. So you guys, if a high quality and large company ever goes down more than 50-60%, it always grabs my attention, and I should have acted with more conviction. But I did start buying in the middle of 2022, somewhere around here. And obviously there was more downside to go, but I didn't have enough conviction, because although it went down 76%, it has then rallied. What is this number going to be? It's since rallied 480%, right? And so the stock and the market is just looking for a reason for this to go down now, I guess 17.8% from all-time highs. So the question is this a good time to enter the stock? And so first, let's understand why it went down, right? So we can see here in 2018, the stock plunged 19% because of bad earnings. So this is a stock that can respond pretty strongly one or the other to earnings. So it's something important to know. And then around this time, the stock went down in 2022 on outlook. So that might have been around earnings, but this is basically where Mark Zuckerberg said, we're going to do the metaverse. We're renaming the company from Facebook to Meta. In the future has everyone wearing headsets, and it was seen just as a vain pet project that was distracting him from the core part of the business. And so that created a really steep sell-off and what proved to be a huge buying opportunity. And then throughout this time period, Zuckerberg said, well, we're going to have the year of efficiency. We're going to tighten our belt, lay some people off, things of that nature, focus on the core of the business. And so the market obviously responded well to that. And so in 2022, the bad word was metaverse. Now in 2023 and 4, the good word has been AI. But when this company is saying that they're now going to invest in AI, and in Mark Zuckerberg's words, it'll be over the next several years before that investment pays off, people don't want to wait that long to make money. So Buffett says the stock market is a vehicle to transfer wealth from the impatient to the patient. So let's figure out what we can about this company and its fair value and see if this is a good entry point. Like the video, subscribe to the channel. We're going to dive right in here. So as always, we're on Qualtrum, a suite of software I pay for, not what I'm affiliated with. and we can just see here the metrics that matter in this stock, some of the headline metrics. Forward PE of 25, which is a little bit high. Free cash flow yield of about 3.6%, or 3.5% rather, which is quite good. And then we also see that this is a company that's now paying a dividend. So this is a mark of a maturing company. And so, in saying that they're going to spend more on AI with CapEx, they also beat earnings, but then they also gave guidance for the next quarter. So in the most recent quarter we have access to is about $36 billion in top line revenue. They guided the next quarter would be something like 36 to 39. So it's a little bit lower than the average consensus, but we have to figure out how the revenue growth of this company um, seems to be progressing to get an idea of the viability of this as an investment. So what we can see here is massive top line revenue growth. Let's focus in over the last 5 years. So we can see over the last 5 years, the company's grown at 19.3% a year. It's absolutely fantastic, earning it a thumbs up. And so we need to keep all of this in mind when we're looking at stuff. Let's take a look at the free cash flow on the company. Over the last 5 years, up about 14.1%. We're going to be using that in our model to figure out the fair value of Meta shares, but a big thumbs up from me there. And so let's also take a look at earnings per share, a metric that can certainly move a stock on Wall Street. Up again about 15%, just a bit under over the last 5 years, earning a thumbs up. Cash and debt looks quite strong. They've got significantly more cash than they do debt, so that'll be a thumbs up. They happen to pay a dividend, albeit a small one, another thumbs up, a sign of this company maturing. And then we can see that over the last 5 years, they've reduced share count by over 2% a year. That's a thumbs up, not diluting shareholders. So I like a lot of what I see here. So the only question is going to be probably valuation. Looking at returns on capital, and this is really important, you guys. So should you be afraid of a company that's successful that's wanting to reinvest in itself? So the market certainly has been. They are scared about the metaverse investments. But what we can see here is, since 2013, we had returns on invested capital of under 17%. And now sits comfortably above 20% on average over the last 3 years. So when you buy stock from Mark Zuckerberg, he can take that and flip that profitably. And so I'm not overly concerned about his ability to have capital efficiency. So it earns a thumbs up, and it sort of is giving away my opinion on the viability of this investment. But looking at profit margin, it's flat-ish. This is their bottom line profit margin, but it hovers near about 25-30%. It's quite good. So it's going to be another thumbs up for me. And then looking at CapEx, this is going up, but it's going to continue to go up. That'll be probably the only thumbs down. And then lastly, historic valuation over the last 10 years is a lot lower than it's ever been for the most part. So a big thumbs up for me. Folks, I'm thinking this is definitely a hold, worst case scenario, or a buy, but let's crunch the numbers here. $439 stock. I'm going to pull up its fair value estimate right now. Hang tight. So here we have those results pulled up, and it actually paints a little bit of a different picture. So I hope that you watch to the end of this video, because I just want to be as transparent as possible. And, in thinking about it, I wanted to rerun the numbers. And so I'm sort of seeing a picture here, where we see a stock that's run 480%. And at this point, it might be quite overvalued, to be frank. So it doesn't mean that I'm selling my shares. I don't sell a share because it's become overvalued, but let's just go through this together. So $20 billion a year in free cash flow. Total debt is 17 billion to 65 billion in total cash. That's quite good. This number of shares. Now, I think for the growth rates, this would be sort of in line with the recent 5 years. And so now we're looking at another 5 years where they can at least maintain that growth rate, going down to 3% over the until forever, and then splitting the difference in the middle at a growth rate of 9%. And so if we need a 10% required rate of return, this is a $440 stock. Looks like it's quite overvalued, frankly, worth about $242. If we reduce the required rate of return because we just feel more optimistic, um, we'd still be showing it on the slightly lower range of being overvalued. But best case scenario today, the value is probably somewhere around $390. So while I do see it as being overvalued at this time, um, I would say that the stock definitely has some downside potential to it, but because of its free cash flow, it's now paying a dividend. It's high return on capital. It's high bottom line profit margin. There are a lot of different catalysts that can keep the stock moving over time to grow into this valuation. And so take all of that, with a grain of salt, consider it, be thoughtful in what you do. But more than anything, thanks so much for tuning in. This is Sean with Not Financial Advice, and I will see you on the next one.